Hi Sandeep, a very warm welcome to Power Talks, and I'm looking forward to hearing from you about your perspective on investing, your journey so far, your outlook towards markets, what to expect in 2026, and honestly so much more. So Sandeep, we'll dive right in.
Yeah.
From what I understand, you started your career around the Harshad Mehta boom back in the 90s, right? And that experience coupled with the 2008 financial crisis sort of took you away from believing in the buy and hold strategy, which is a very traditional strategy, right? Towards something more quantitative and data driven. So can you tell me a bit about how those early years were and how did it shape your approach towards investing?
Okay. So a lot of people have very bad memories for Harsha's phase. I have a very good memories. Okay. Because this is the time when I was very early, and that's the time I actually booked profit. Okay. When I say book profit, obviously I didn't have any assets at that stage. Okay. I was in college days. So whatever family has some, my dad was a banker, uncle was banker. So they have some old shares. So we sold. So I were actually instrumental in selling. I saw something unusual. Okay. So this is something we call it like in from a behavior perspective, classic maniac phase. It actually was a maniac phase. Okay. Till 2021 or even 2008 or 2018 also, all the peak of the cycle, we have not seen the repetition of that maniac phase. Okay. My biggest learning came purely from a behavior perspective. We didn't have a clue about behavior finance, okay, or behavior analytics at that stage, but that was something which was very puzzling my mind, okay, how to decode these numbers, can I quantify, okay, and there's a genesis of predictive analytics comes into picture, because that was the starting point. So and then Bombay National Stock Exchange was formed. So we are talking about somewhere closer to 94 or so. So very early stages of data analytics. So we started looking at data since then, and since then I have a inclination or passion towards data analytics. So very early stages, but it's the first good lesson.
Understood. And you also have experience across various financial institutions, right? Including derivatives and behavior analysis.
Yeah.
How did that shape your approach towards risk management?
Okay. So frankly speaking, I always say that I was always associated with the startups. Okay. So whether you talk about any company which I work for, when I work for Bennett and Coleman, I was like first management graduate. People used to hire the journalist. Okay. So in the Economic Times Research Bureau, we set up an Economic Times Investment Bureau. Okay. So early stages of hiring people, so instead of journalists, we were hiring management graduate, chartered accountant, early stages. So you read that colored paper today, the pink paper, which was all pink paper. I was instrumental in the infographics department, making changes, the 2 rupees newspaper campaign. So very early stages where Economic Time got changed. Okay. Then again, I was very early stages I was the first employee of IDBI Mutual Fund. In those days was joint venture actually with Fidelity. Okay. It was known as India Asset Management Company. Whatever reason, it never took off in that form, and IDBI came in on their own. Okay. So I was the first employee of that company again, and I'm talking about way back in 95, very early stages.
I hear a lot of innovation, and that's a very pioneering mindset also.
Yeah.
I also read that you were the first one to make a transaction of a derivative fund back in 2001, if I'm not wrong.
Yeah, understand that we were very early in that derivatives also, when the Indian form of derivatives. So I used to work for ISEC, in those days, and broker was allowed to play in the derivative market in so-called Badla market. So I was very early in doing research on Badla markets. Okay. And I did project for some larger institution as a trainee, and then when I was working there, so I was used to participate in the Badla market. So that's also an important reason when you play, and I was a very large player in that stage. So when you participate through Badla market, you understand the behavior side. So Badla rates gives you a very good perspective. We were very young, okay, so that fun was very different.
Nice. I'd like to jump to the quant funds performance over the last few years, right?
Yeah.
So of course we know that between 2020 and 2022 the performance was stellar. A lot of schemes outperformed, and then in 2024 we also saw an underperformance era with quant, right? With the flagship schemes like small cap and mid cap also underperforming. So I want to understand from you, what do you think happened there?
So let's understand our philosophy first. So we always say in a risk on period, we will generate extraordinary alpha,
right,
which will keep it for difficult phase. In risk off period, we will lie low and protect the capital, and even you underperform, that's a part of our strategy. See, what is very important to understand that when people talk about this business, everybody talks about returns. Nobody looks at the risk. It's about the scheme return, maybe relative returns to benchmark or relative to competition. That's what people look at. So best of the people say we understand risk, but those risks are there on paper. Nobody looked at the risk number on day-to-day basis. So we very boldly write, we are in the business of risk management. Returns are byproduct. Right. You have to manage your risk better. Okay. Now, when we talk about a risk measure, from a risk perspective, risk if you are late, okay, then it does not make sense. So, from a when we say to identify a risk, you have to be ahead of the curve. Okay, you cannot do a post-mortem analysis. Oh, that was the risk off period. That's the reason we suffered. Okay, so that is our job. Now, we don't do post-mortem analysis. We have a thesis of called predictive analytics, where we predict the markets.
So it's not retrospective.
Yes,
it's predictive.
It's a predictive. Now let's understand predictive analytics has So it's like, let's understand it's not we are a student of astrology. Okay, that we can see the future based on something. That is also a science, but very limited people understand. Okay. What is very important, we say predictive analytics is the probabilistic science, not deterministic science. Okay. When I say is a probabilistic science, means we are able to quantify. So in the theory of probability, say what is the probability of this happening? Nobody can give you with certainty. Only God can tell you with certainty this can happen. Okay. None of the human beings can tell. So we always say predictive analytics is a probabilistic science, which means we are trying to identify what could be the probability of that event. Wherever we see higher probability, those are the areas where we take trades, right, or get our portfolio skewed in that direction. And that's the reason mathematically we have done our own analysis. And in the previous book, we talked about our track record, and we have showcased prior book which has come. We have 72% track record. In general, we always say that 28% time we are always wrong. Okay, 72% time we get it right. And that itself is a very good number. Mathematically, it's a very good number. If you are like nearly 2/3 times you are right and 1/3 you are wrong, broadly, then it's a good statistical measure. Okay. Now, what is important? Let's understand. From 2020, we made very good return because that was the year when everybody has capitulated. People have given up. We spotted that opportunity because we were prepared. Because if you read our book, which was published in 2019, and some data points, we have a J curve and we have talked about future. In 2012, we have written how 2020 and 2019 till 2030 will be a very difficult phase. And we have predicted that global market will have a meltdown in 2020. Okay. We have talked about cyber war, biological war, deteriorating weather condition. Mathematically, based on cycle analytics, we have predicted these things, written in 2012, published in 2012, and showcased in 2019 book again. Okay. So we were mentally prepared for an event unfolding. Now, when something was written 13 years back, it's very difficult to visualize that. But when you look back in today, and when we saw the data points coming closer, we were very convinced. So let's say example, right from September 2019, we were cutting down our exposure through the leverage economy stocks or the so-called economic stocks. Okay. What we were adding? FMCG, pharma, healthcare, and IT. These are the only sectors. So if you ask me, our 70% exposure was this. 31st March 2020. Our banking exposure, metal exposure, or leverage economy stocks was zilch in our portfolio. Okay, we were prepared for that. Okay, then this event unfolded. We were prepared for that event. We optimized that opportunity in going long. Okay, where people were giving up, we were buyer. Okay, so that's the one edge you get as a part of a behavior. Now let's extend the same thesis in 2024. In 2024, July 2024, after long period of time, we saw a risk off period India. Based on our high frequency analytics, we talked about that India, something has changed. Though we always said that long term is good, but we said that easy phase of bull run is getting over. Okay. Now, when we have that aggressive view based on data, we don't take a gut feeling call. It's a data analytics form. So we always say, objectivity is our religion and data is God. So everything revolves around data. When data is telling you that this is knocking your doors, what you will do? The basic strategy in risk off period is that you move from high beta to low beta portfolio, you move from illiquid to liquid, and you move from mid and small to large cap. This is what traditional money manager or thinker will do.
So these are the changes that happen when a risk off period
Comes
is starting.
Yeah.
Okay.
So we said it's a mild risk off, and we were very clear. And since we have given so phenomenal returns of past, and it's a human cycle. When you have outperformed so much, and when you saw first after a long period of time something is very disturbing in terms of data, naturally you become more aggressive, more cautious, so as compared to what it should be. Okay, this is again a postmortem analysis. Okay, but at that moment we say, okay, last 4 years is so good, let's play safe. This is a human psyche we have given extraordinary to. We came with a mindset, let preserve the wealth rather than be aggressive at that stage. Okay, as a risk manager, that's our strategy, and we did that. So by September, October, okay, or let's say by September, October, our portfolio was largely skewed towards large cap. We did in this let's say 4-5 months period, but where we got hurt purely, if I have to talk about the postmortem analysis, when this China episode happened, the stimulus came from China. Okay, there's a very large stimulus came, this is something what I call it unknown risk. Known risk you can still forecast. Unknown risk something, anything government takes step. Okay, today let's say rupee is becoming weak and RBI can intervene. That is a known fact. RBI should do it and will do it. Okay, now if RBI let's say don't do it at all and rupee becomes 100, I'm just giving example, that is unknown risk, because people perceive this will happen. When the China stimulus happened, nobody was perceiving anything like the big stimulus came. So obviously the so-called FIs, what they do, for them India is one of the country, so they were looking at relative opportunity in China was better, valuation was far more attractive. China has underperformed for a long period of time. Money switched. And when switching phenomena happened, what they had predominantly large caps. So in that period, mid and small was continuing to moving up. So we got hurt marginally there. The bigger hit came when our large cap got smashed. So something down 20%, 30%, So it's a very large impact which we felt in that period. Okay. And that's one of the reason our big underperformance came in that period. But now what is very important to understand, I always say in risk off you lie low. Even you are underperforming, you have to lie low. The mistake which most of the people do, when you are underperforming, again when I say underperforming, in that period, if somebody say I'm a long-term investor, 5 year, we are still one of the best, we are still in the top quartile.
Sure.
But somebody just looking at only one data points or few data points and they say this period, then what happens as a money manager, you come under tremendous pressure. Critics, social media, comments on that. Okay. Then people try to recover, and when you try to recover in a risk off period, you tend to make mistakes. Okay. And I'm saying that we have seen there enough example. I don't want to quote individual fund houses name what happened and then they suffered. It's our learning. In risk off period, just control your emotions, lie low. Even you are underperforming. Now you look at in last 3-4 months when we have been saying from that India is a risk on. Last 3 months I'm saying I'm more constructive on India as compared to developed market. We are largely invested. Okay, we said 2 months back India will make all-time high. Okay, in the beginning, let's say if I go back and say when January 2024, a lot of question came when India started underperforming and people were worried. People I say how the year 2025 would be.
Right.
So I said that first half will be lower than the second half. Look, second half will be better than the first half, and within first half, first quarter will be the worst, which played out. So this was the case, and I also made a lot of question came by end of 2025 whether we'll get a positive returns or not. That was the biggest worry in the beginning. So I said whatever low you have seen on 31st December 2024, 31st December 2025 will be significantly higher. And now we are just there, and we are already 8-9% higher than what we were. okay, and I'm very confident it will be more than double-digit returns gains as compared to what we have seen on 31st December 2024. Now, somebody asked me how you were confident about it. Okay, that's the way our analytics plays a role. Okay, and we are very vocal house. We don't use the mince our word and say could be, might be, would be. Okay, it's a very, we don't make politically right statements. Could be, I believe so. Okay, because if I believe in data, whatever data is telling you, I will tell you. If data change, I will also change my view, and I will communicate that also it has changed. Okay. So it's very important to get that perspective, you know, and hence what we said that is a risk of, yes, maybe become more conservative. Postmortem analysis I could have felt. Maybe it was, let's say our team, and sometimes one of the very interesting distributor described us quite well. He says your diagnosis was perfect, but prescription was not good.
How?
Which means,
what does that mean?
Which means the problem we spotted very well, is a risk off period, and this is a, okay, we were early to spot, but the stock selection which happened was not up to the mark to protect your downside.
Okay.
That what he meant, and he was actually on dot. His observation was very good. And in fact, if we go back and analyze what went wrong, we'll say our mid cap selection was not at all good. It's one of the mid cap underperformed significantly, and that led to a underperformance. But one way of commenting is that you say that, yeah, these are my long term thesis, I will wait for that. We understood the problem. We have already revamped 80% of our portfolio. We are going to further revamp 20% in next 1 month.
Across mid cap and large cap?
Across all the schemes. Okay. We don't look at one scheme, you know, it's a process. But I don't want to take a U-turn like this. Okay. Other important reason of underperformance that was we didn't participate in any of the new age companies. Last year when Indian economy was suffering, new age companies, so-called these most admired territory stocks, which I defined it, did very well because not the bottom line, at least they were growing very well. The top line was good, the growth momentum was there. So lot many money shifted towards this sort of momentum. We as a house have two problems. A, if we don't have historical data of this company, we don't tend to participate. That's the one big problem because we are data driven house.
Very right.
Yeah, we need 10 years of data at least to analyze a cycles or fundamental momentum or earnings or anything which you look at. Okay, not only the price part. Okay, for us earning momentum is also very important. Once we realize we don't have, we don't get into that. Second thing, we strongly felt something is not right. Okay, and it's not the first time we are seeing. I have seen many cycles in life when people get carried away, and best of the names will be carried away. That's the way tops are made in these stocks. Okay, we have been taught, you know, about operating cash flow, free cash flow, but you ask best of the money manager, they will not able to defend. Okay, these, where is the operating cash flows? Okay, people, we look at 1 year, 2 years, 3 years max. Worst case scenario 5 years. Even some of the company on 5-year perspective also is not viable.
Okay.
But that was the phase. It did very well. We didn't participate. One of the also reason where we suffered a lot was this massive outperformance happened. Particularly these names were largely in the mid cap space. Okay.
Where the stock selection was not ideal.
And space. Plus we didn't participate in these names also. Okay.
But then how does a fund house which is so data driven, you said that, you know, you have to look at data to make your stock selection, but then how will you ever take positions in new age companies?
So that's the challenge which we have.
Okay.
Okay. So what happens if companies are very, very old, okay, 10 years if they have history, we can download, you know, their track record from MC and we can still do something. Okay. When companies are very new, okay, then it becomes a challenging part. So obviously what you have to look at, you have to look at the sector data, you have to look at the global data. But when we felt that globally these companies are not even valued at these levels, okay, let's talk about NVIDIA, talk 26 times, okay, not at all expensive. So somebody asked me, oh, there's a bubble in the US. I said, no, there's no bubble in the US. Actually bubble is here. Here you are giving value not in terms of P, in terms of price to sales, and not few times, 18 times, 20 times, and so there's no visibility of these numbers. So I'm not criticizing that we missed out or we have regret. it's a part of a philosophy. If we don't understand,
Right.
we will prefer to avoid it rather than getting carried away in these names and then regret later stage, it was a mistake, this is something which we have not understood and now we are stuck. Okay.
Right.
So it's a question of how you look at it, it's your philosophic approach. So there are many fund houses who believe that new age companies should be part of your portfolio 10%. So we do have few new age companies, but wherever we are seeing a cash flow visibility, some sort of hope of profits are coming, you can still participate, but something which is just purely story, this will happen, this is the growth area, we are like to be conservative rather than getting carried away. So we are very okay.
Very true to your investing philosophy,
Yes.
which is being data.
I always tell a lot of investor, if something Gaurav also talks about, if you don't understand, avoid it. Okay, don't carry it away because somebody. See, the problem in India is, and this is one observation I've seen as a behavior analyst. Conviction is not with your ideas. Conviction is somebody else. Oh, this particular fund has bought, so it's good. They have subscribed the IPO, it should be good. Okay. And if issue is subscribed 5 times, 20 times, 50 times, then people stand in queue to subscribe because people believe somebody else has done the better job than them. So they are buying on somebody else's conviction. Where in our case we buy on our conviction and our data analytics, so we don't follow the crowd.
Got it. But also it brings me to the question, Sandeep, that quant has outperformed during bull cycles and has underperformed when the market was a little sideways.
No, it's not correct observation. Why?
Okay.
If you look at in 2020 also September there was a sharp fall. September 2021 also was a very sharp fall. So is the case in some patches in 2023 also. Okay. So it's not fair to assess. Okay. Within that bull run of 40 years also you have seen multiple times of thing. We have not seen the extended correction which we saw in last 1 year. I will say, instead of saying correction, I will say 2 data points. First, the impact cost has remained elevated for a while. We saw impact cost rising somewhere in mid of 2024, and since then they have not corrected. Otherwise, what happened, it used to spike for a quarter or few months and then it comes down. Okay. This time impact cost has been remained elevated for a long period of time, which obviously hurt, okay, your rotation strategy. When you are looking for a churn, and our thesis was that we rotate and make money. Okay.
Right.
If my rotation process becomes expensive, let's say if I want to buy something liquid name, okay, and reasonably liquid name, large cap name, and the impact cost is 7-8% of buying and 7-8% of other stocks selling. So if impact cost itself is 15%, that is the return what I was expecting for the year.
Right.
So it does not make sense, and hence we are also lying low. So we have to also go back and understand. Now if somebody says that yes it happened, what steps you have taken? Yes, we have taken some steps. We have understood if this phenomena is going to last long, some changes we have made.
Right.
Okay.
So could you talk maybe in a very like step-by-step way about what kind of steps did you take for this correction to happen? Because quant is already in recovery mode, right? Things are already getting better. What changes did you make for that to happen?
So first thing, what we have made, our portfolio, we always give focus on liquidity because we don't charge, most of the scheme don't have exit loads. Okay. We generally keep portfolio more liquid, but this time even we are moving towards rather saying extraordinary liquid stocks. Okay, 2 reasons. I always say in a risk off period, liquidity is very vital, safety is second, and return is the third. So the perspective changes. If I am in the risk off period, largely risk off, mild risk on which is going on, which is correct, then I will look for my liquidity first. What we have done, we have tried to make our portfolio more liquid. The advantage of my portfolio now is that I am able to relatively churn better. Because very liquid portfolio which we are dealing. Second thing what we have done, we have started looking into blocks in a big way. So instead of looking at on the screen, we now do lot many volumes through block trading. So block is another focus area for us, and we recruited dedicated people for that. We change our mindset. This is something which we are not changing our strategy. Okay, we are saying what are the obstacle in executing our strategy. We understood that and we are making those changes.
So we were talking about risk on and risk off periods. What is your outlook for 2026 in that way? Are we in a risk on period right now, and what do you think
Currently,
the outlook
in
is?
India, on relative basis, we are in risk on period.
Okay.
The way I look at 2026, let me give you, instead of 26, let me say next 5 years. Next 5 years is going to be challenging phase. Vicky, when I say challenging, yes, we are in bull run, difficult phase of bull run. Okay, we are in decisive bull run, but difficult phase.
What is the difference for like a layman investor, for our
layman means when you are a structure like 2020 to 2024, though you have seen bouts of volatility there also, small correction,
right,
but it was a structure bull run, 4 years of massive returns. That phase is over. Now you will see whipsaws, volatility, and you have to prune down your expectation first. Okay, because people are used to such high level of expectation. See, we earlier used to say 10-12% return, very happy.
What should be the new expectation?
Okay, I think we should get back to this 12-13% return expectation, 10 to 13% expectation. Then you will not be frustrated. Okay, you will say, okay, somebody generated 14%. Oh, we are happy about it. Okay, the problem starts when you have expectation of 25-30, which you got for a small period of time, and now you say this is my new benchmark. Like how interest rate became negative, which was never the case, and now it suddenly become US interest at 4% yield or 5% yield. People are saying, oh, big numbers. But in the past, we were used to 4-5%.
Right.
Okay, because some abnormal thing happened. Because of that, you cannot, like crude prices were trading in negative territory. Now you can't say that is that was the fair number. Okay, those were extraordinary situation. Those should not become a benchmark. And that's the reason last 3-4 years should not become your benchmark. Otherwise, psychologically, you will never be a satisfied investor. You will be unhappy all the time because you are so, you have kept your benchmark. Then basically, which means if somebody has to generate that sort of return, it means you will be taking more risk. And more risk is not very advisable in today's context. That's the first point. Second point is that instead of saying let's how the view will be 2026, what we have recently, let's look at quarter first.
Okay.
Okay. So we have said in Diwali ring that so this Samvat 2082 Samvat, first quarter I am constructive. So between 21st October till 28th January, we have released our note saying that view is constructive. We will see and review in January after that. No point.
So no view made on January yet?
No, but I am not negative, let me put this way, but I am saying that we will form opinion as and when it happens. So in January we will review for next 1 quarter, rather than saying that, so long term anyway is very good for India, isn't very, you always say. But can I say that everything is good, then I remain invested, then the same problem come. You will not do sector rotation, you will not do stock rotation, you say I am long term, and then you suffer. Okay, then investor will not like it.
So for the next 5 years, you said are going to be a bit of a challenging time, right?
Yes.
Which sectors during these 5 years then do you think you will go bullish on?
So I tell you again, too premature to take about 5-year call also on a sector. Okay. My current focus is that we like large infra names. Okay. We like hotel stocks. That's a hospitality as an area because tourism, including the tourism part. We like NBFCs as space. We have never been a big believer of banks in the past, but today we have a very skewed portfolio towards banks, and insurance we like from the current level. So some of the pharma has been a theme which we like. We think consumption selectively one should look at. So as of now, these are the large themes which we are looking at, but too premature to take a 5-year view. Okay, it will not be fair also to talk about when we ourselves say that it is going to be challenging time, and then I am giving you 4 years clear view, then I am contradicting myself.
No, absolutely. I also was curious to understand, Sandeep, that you spoke about the risk on and risk off periods. How do funds manage to get their timing correct in such a thing? Like, how do you make sure that you're not too early and you're not too late? For example, even in 2024, I think mid of 2024 onwards, you adopted to a risk off strategy. Even though much of 2024, the market was rallying. So how do you make sure that you're not too early and not too late?
See, as I said, in the risk is all about being ahead. If you are late, then you will be out of this business. Okay, because postmortem analysis is always going to be very easy. But the advantage is all this. So like we were early, so you said, say always say 28% you will not get it right. But say, like how 2020 we got it right. Okay, how
Right.
September 2021 when we say money shifting from growth to value we got it right. So there will be phase where you will not get right everything. But ultimately what we are doing, we are slave of data. Whatever data will tell us, we believe
will
in that.
follow.
Okay?
Okay.
We don't try to bring our own biases or color their opinion. Ki somebody, big guy has now upgraded this stock. Okay, or somebody has influencer is talking about this name. That's not the way we should be. We actually use that opportunity to sell. Okay,
So,
so
no
we don't get carried away.
qualitative layer, no qualitative layer is applied to data.
No, qualitative is based. So 1/3 when we say fundamental analysis or
Right.
valuation analysis, that is your qualitative. So qualitative, quantitative and behavior, all three 1/3. So there is a base, but qualitative is in isolation does not make sense. In combination makes sense. Like a lot of people look at next 5 years. We look at everything from past data. Okay, because looking future is good. We use those things as a trigger points or as a catalyst. But decisions is not based because some analyst has told you the next 5-year earnings is this much. Because that is also based on certain assumptions. If the assumption goes haywire, the call is actually you will sitting on huge losses. Okay, and you can't blame something on the analyst. His call was wrong, because ultimately is your baby. You are responsible for success as well as failures. So what we do is saying that let's not get into something which has a futuristic thing. Yes, with the help of perception analytics, we can quantify the multiple also. So what is very important, earning expansion and multiple expansion or compression, both are very important. So most of the analysts gets into, or the money managers are only in earning expansion cycle or compression cycle.
Okay.
We are also in a multiple expansion or compression cycle. That is something we do through the help of quant.
Okay. So what does churn look like going forward for quant? Because it used to be like quant has always been a high churn fund house, right? I mean, I think data suggests that the churn has been even around 400 to 500%
in the past. Yes,
in the past, and lately it has been closer to 100 to 150%, if I'm not wrong.
So I will say, first of all, let's understand the terminology churn. It's a very we have created this terminology in India.
Not at
only.
all. I've read you say, I've heard you say that churn is not bad. Wrong churn is bad.
Okay. So first of all, let's understand, we should not use the word churn. None of the portfolio management books have taught this term churn.
Sure.
It's only India portfolio management has. Okay. It's all about rebalancing. If my money management skill set is so dynamic, my rebalancing will also be dynamic.
Right.
And if rebalancing is generating alpha and if rebalancing is controlling my risk, then churn is good. That
Absolutely.
rebalancing is actually good, because we as a mutual fund has a huge tax efficiency. Okay, if I'm using the tax efficiency in protecting my downside, okay, and leaving my upside open, that strategy is good. But somehow industry has taught wrong things. High churn means no clarity, no conviction, and hence is a churn. No, that's not the way. Okay.
It's taking advantage of an opportunity. But
Yes.
why then has quant reduced the
So I
churn?
explained you earlier, when the impact cost has risen sharply, the
So
churn
the-
will by default will come down.
the
It was not
major
making
reason-
sense.
Understood. So the major reason has been the impact cost only.
Yes.
Otherwise, quant's philosophy continues to be that
Same
whenever
thing. Now we have started doing blocks in a big way. So
Okay.
we have strategy has not changed. We have figured out a way to doing it.
Okay.
Instead of, so we have moved towards DMA in a big way. So we have made some changes. See, what happens, also understand, quant has also grown vertically, okay, in that 4 years, from 27 crore to 1 lakh crore journey in nearly 4.5 years, which we see, which is a very unique case study in India and actually in the globe. We have never seen somebody has grown this pace, okay, from 8,000 investor to 1 crore investor, which we have today. It's a very large base. You never got time even to realize. Okay, so we also have not anticipated this growth. Okay,
Right.
so it takes time to make those changes. Okay, we always wanted to do it, but at that stage we were struggling with our growth. Now in last 1.5 year we got a consolidation phase in the market also. We have also consolidated and we have implemented so many changes in our firm which we are actually doing for last 2 years. Okay, but now it is seeing the impact. Okay, any change you do, it takes 6 months, 9 months to you also also realize the real change happening. After 1 year, you feel, yeah, this change has resulted into a good thing. So we are making, and again you have to understand, quant as a house is very technology driven, process driven house. So any change which will be very difficult for any other house to implement is very easy, because we are in-house tech team. It's very easy for us to roll out that thing as compared to industry.
Got it. So of course, quant as a fund house is extremely data driven, like you said. How does the advent of AI and machine learning change that, or help that in the next few years? What is your take on that?
So let's understand, today AI and ML is good, but too much hype is there. Okay. Now let's understand, when we say predictive analytics, it's so effectively we were using this AI in our way. Okay. So for last 30 years we have predictive analytics. It's a AI tool only. In today's context, if you want to call it, we call it predictive analytics.
Right.
If I show this technique to anybody, he says this is AI. Okay. Yeah. But when we started, there was no like AI. It's all about analytics. Now with the AI coming into picture and ML, our ability to process data is very fast. We anyway were doing earlier also.
Right.
It's not, we have a very large computing skill set. So it's not like without AI also we used to do, because we used to invest a lot on high frequency blade server and other thing, which is, and we invest and every 5 years those servers are changed because they become outdated. Okay, change. Now with this advent of this tool, we think we will only expand or multiply our outcomes because of the technology or the processing capability. So we are user of these thought process,
right,
and we will be implementing in a more aggressive manner in future also.
Okay. So you will only double down on the existing, philosophy.
Double down will be to less intensity.
Okay.
It will be few times.
Okay, understood. Great, Sandeep. I also want to, I have to ask as a curious investor, what is, how do you invest? Are your most investments in the, quant funds only? Are there other asset classes that you, have high conviction in?
So earlier I used to invest in markets also, because that's the way my learning has been. Okay, we have been investor right from 90s, so it's not like the first time we invested.
Right.
But in last 2018 onwards, rather 2015 onwards, I have largely invested in my schemes. Today, 100% of my portfolio is in my schemes.
Okay.
So it's 100%.
100% of your entire portfolio, or 100% of your mutual fund? Okay.
My
your equity
entire
portfolio.
equity portfolio is here.
Okay. Are there any other asset classes that you?
Obviously, you about to have some few houses,
right,
and other thing,
Right.
So those are the natural thing. But since then we have started our mutual fund. I have not invested anywhere else. Everything is in our fund house. So we always say, quant as a fund house, I have highest skin in the game is with quant.
Yeah, yeah. I've heard you say that.
Okay, and it makes sense, See what happens when you do. Why we stop it? I'll give you a very simple answer. No regulatory restriction. We can take compliance approval and do invest, and we have certain SEBI has defined certain rule. When you invest on your own, your biases come into picture. Even you say 5,000 shares, you start trading. It affects your thinking process. Your first focus goes towards your own ideas, your own investments. Okay,
right,
and it creates disturbance. I have seen that. Okay, and I have seen people who write research report and they invest, their thinking is very different. So I always tell regulator also informally, the way you have skin in the game for fund managers, there should be skin in the game for the analyst also. They just write and forget it. If they invest what they are writing, even small percentage, their research will be better, because their conviction
and their
will be.
behavior analysis could be better, right?
Yes.
What you were saying earlier, that you often ask people that, how did you behave during the, Harshad Mehta cycle, or 2008. So if the analysts themselves have skin in the game, they will be able to empathize better with what investors are feeling.
Because the commitment is very different. A tracking level is different. Your personal money is involved.
Yes.
Here, when we manage our public money, our 100% money is also here, na? So our vested interest is also associated. So it is a perfect alignment.
So you're making, your goal becomes twofold. You're making money for yourself and for your investors, right?
Okay. So and then you don't have your personal investment does not create any disturbance in your mind or in terms of priority that I have to manage that first and this becomes secondary. Okay. So that's one problem, but second most important problem is the biases. If I have some holdings, then that biases I will bring here in the fund also. And I have seen that creates some problem.
So if you're invested 100% in your own schemes, you're able to keep the biases at bay.
Yes. Because 100% is there, I don't have any other distraction.
Right.
Okay, the entire focus is here. Let's say we are negative on something and there I am positive view. Then I am not able to do justice here. I will not exit here because I have a positive view there. It's confuse you. Okay. And I have seen, let's say reason globally, when any family office or large pension fund gives you money to a hedge fund or thing, they say what is your skin in the game. Okay, that's the reason when anybody start their fund or hedge fund, they say my 100% money is here. Okay. And that commitment is very important when third party is putting money in your fund. Okay. Now I have seen in the industry regulations allows money manager to do it. So lot many money manager have their personal portfolio also as the mutual fund portfolio. There's nothing wrong in that, but I see it create disturbance, and that's the reason we don't do it. Okay. As a house, we encourage all our staff, all our money manager analysts to put 100% money, the focus remains the same.
Okay. So Sandeep, of course, a lot of our investors in their 30s are the are the people who will watch this podcast. What is your advice for them today? What to expect in the next few years? How should they go about their investing?
See, the only advice which was there is that investment is mission critical, I will say. Okay. You should not say that this is, if I have some saving, then I will invest. You have to create this saving because this gives you a lot of cushion from long term, and it's a good habit. When you invest, your analytical mindset also becomes more sharpened. Okay, your reflexes are very different. Okay, because you are a good investor. So I always advise to invest from early stages. A lot of people say, let me buy a house first. Let me get married first, let me settle my kid. This is investment I will look at much later when I have surplus. Okay. No, you should, whatever is the amount, I am not saying that you have to pull out 30%, a lot of people who is like saving rate in 26%, 2%, 5%, 10%, depending on your comfort factor. I am not saying you sacrifice your life and invest, but this is a good habit you should inculcate from a longer term perspective. Saving is a habit, it's not a compulsion.
Right.
The moment you change thought process that come from a compulsion to a habit, perspective changes.
Let's say someone starts investing in the market today. What can they expect in the next few years?
See, I tell you, if you are a long-term investor and you are looking for systematic investing sort of thing, I think equity and asset class will outperform every other asset class from a long-term perspective. It's a known fact. But India is in a very constructive, we are very positive till 2047. That's the time India demographic cycle will change. So we always say that something has changed for India. Okay, and India P multiple will remain expensive from longer term perspective, and hence it does not make sense to say that India is very expensive, I will not participate. India will remain expensive. Like in Bombay, property prices always remain expensive. Okay, 30 years back also it was expensive, and today also is very expensive. Right. Okay, so if I have not bought 30 years back, today I regret. So that's the way I say remain invested based on your risk appetite, based on investment horizon, and mutual fund is a great product.
We agree.
Yes, and SIF is also a very unique product which you are coming. Somebody say I am very conservative, I'm not used to certain drawdowns, then SIF is also a great product.